Welcome along to the deep dive. We've got quite a bit to get through today, looking at a major Malaysian conglomerate.
We do. We're diving into Berjaya Corporation Berhad BCorp, as most people know it. And yeah, it's a familiar name, but their business interests are really quite diverse.
Absolutely. So our goal today is to unpack their latest numbers, the Q3 and the 9-month results ending March 31st, 2025. We want to get a feel for the overall financial health, which bits are working well, which aren't, and importantly, what they seem to be doing about it, this whole restructuring piece.
And we're pulling this from their official reports, Q325, Q225, Q324, plus an article from The Edge, and some generated analysis docs that sort of help frame everything.
Okay, before we jump into the latest figures, maybe just remind us quickly, how broad is BCorp? What kind of businesses are we actually talking about here?
Sure. I mean, looking at their own segment reporting, it's pretty varied. You've got the marketing of consumer products and services that split into retail, both non-food and food.
Right.
Then there's property investment and development. Hotels and resorts, which falls under hospitality, and a big one, gaming operations, which they classify under services.
It really is a mix. Okay, let's tackle the recent performance then. The 3 months ending March 31st, 2025. How did that stack up against the same quarter last year, Q3 2024? What are the big numbers?
Well, revenue for this latest quarter, Q3 2025, came in at RM 2.54 billion.
Okay.
Now, that's down from RM 2.78 billion in Q3 2024. So yeah, an 8% drop year on year for the quarter.
8% down on the top line. But I gather the profit picture showed an even bigger shift.
It did, and this is the number that really catches your eye, but needs some important context. For Q3 2025, the group actually reported a pre-tax loss.
A loss?
Yeah, RM 8.88 million pre-tax loss. Compare that to Q3 2024, where they posted a pre-tax profit of, wait for it, RM 773.66 million.
Wow. Okay, from over 770 million profit to a loss. That's a massive swing in just 12 months. Does that mean the underlying business has just collapsed?
Not exactly, and this is crucial. That huge profit figure in Q3 2024 wasn't just from regular operations. The report is clear. It included very significant exceptional gains.
Exceptional gains.
We're talking RM 652 million worth. Yeah, mostly from selling off some subsidiary companies and also remeasuring the value of equity they kept in others.
Okay. So big one-off items from disposals and revaluations boosted the previous year's numbers massively, things that don't happen every quarter.
Precisely. They aren't operational profits you'd expect to repeat. So you take that RM 652 million boost out of the comparison, and suddenly this year's Q3 loss, while not great, doesn't look quite as catastrophic compared to last year's headline profit.
Got it. The absence of those huge one-offs makes the comparison look far more dramatic than the shift in just day-to-day business performance. Though the analysis did mention something from the Edge article.
That's right. The analysis pointed out, referencing the Edge, that this Q3 loss actually marks the 4th straight quarter that BCorp has been in the red. So it's not just a one-quarter blip.
4 consecutive quarters of losses. Okay. So let's broaden the view. What about the year-to-date? The full 9 months ending March 31st, 2025, compared to the same stretch last year. Similar story.
Pretty similar trend, yes. For the 9 months, revenue was RM 6.97 billion this year. That's down from RM 7.58 billion for the same period last year.
So again, about an 8% decrease year-to-date, consistent with the quarterly trend.
Exactly.
And the bottom line for the 9 months, profit or loss?
For the 9 months ended March 31st, 2025, the group recorded a pre-tax loss of RM 149.47 million.
Okay, a loss for the 9 months too. And how does that compare to the previous year's 9 months?
Well, last year, for the same 9-month period, they had a pre-tax profit of RM 751.65 million.
Right, so another really big swing from profit to loss over the longer period as well. Is the explanation similar?
Yes, largely. The report attributes the 9-month loss mainly to lower operating profit, pointing specifically to weaker performance in the property and the retail food segments. And just like the quarterly result, that huge profit figure from last year's 9 months also included those same big exceptional gains.
The RM 652 million again.
That same RM 652 million boost was in the prior year's 9-month figures too. So again, it makes the year-on-year comparison look stark.
Okay, so the overall narrative seems to be revenue down slightly, profit swung to losses, but a huge chunk of that swing is because last year had massive one-off gains from asset sales that weren't repeated this year, plus some genuine operational weakness in specific areas. The analysis also mentioned the Edge reporting a net loss for the 9 months of around RM 348 million.
Yes, that figure was noted in the analysis based on the Edge's reporting. It underscores the loss-making position over that period.
Right. So let's dig into that operational side now. Which parts of this diverse B Corp empire are actually doing well and which ones are struggling?
Okay, let's start with the positives. The services segment, that's where the gaming operations, as TM Lottery, said that division reported higher pre-tax profit. And that was true for both the recent quarter and the full 9 months.
So gaming is a consistent bright spot. What's driving that? Just more people playing.
The reports say it's mainly down to higher revenue, so yes, likely more activity, but also coupled with a lower prize payout ratio during these periods. So a combination of factors benefiting the bottom line there.
Interesting. Lower payouts always help. Okay, where else are things looking relatively strong?
The retail segment, but specifically the non-food part, that also showed a higher pre-tax profit in the latest quarter. Again, primarily driven by higher revenue.
Non-food retail. What's included there?
Well, the analysis document actually gives some color on this. It points to strong performance from HR Owen, that's their luxury car dealership business over in the UK. Apparently, the new Lotus mark helped drive sales there.
Ah, luxury cars holding up well. Interesting. And didn't the analysis also mention something about cost savings helping another part of non-food retail?
It did, yes. It mentioned Causeway, which is their direct selling business. Apparently, a strategic cost rationalization exercise there helped improve Causeway's profitability, even though Causeway's actual revenue was lower.
So a bit of belt-tightening paying off for Causeway, while luxury cars drive the top line elsewhere in that segment. Okay, that covers the stronger areas. Now, what about the segments that are finding things tougher?
The other side of retail, the food segment, that reported lower revenue for the quarter and significantly a pre-tax loss for both the quarter and the 9-month period.
A loss in food retail. Ouch. What went wrong there?
The reports explicitly mention the closure of their Papa John's pizza operations in the Philippines. That obviously hit revenue and profit.
Right, pulling out of a market.
The analysis also hints, based on context from previous reports perhaps, that other brands like Kenny Rogers Roasters might also be underperforming. But beyond specific brands, the reports list a whole raft of factors impacting food retail.
Yeah.
Things like, the timing of festive seasons, tourism levels, the general culture of eating out, rising costs for raw materials and staff, and even shifts in consumer tastes and preferences may be linked to lifestyle changes.
Sounds like they got hit by multiple things at once. Operational changes like the Papa John's exit, plus broader market pressures on costs and demand. A tough environment.
Definitely seems that way.
Okay, what about the property segment? You mentioned that was weaker too.
Yes, property saw its revenue fall in the current quarter. The main reason cited was the completion of a major project, the Tropica, in Bukit Jalil, during the previous year. So as that project naturally wound down, the revenue contribution dropped off.
Ah, the lumpy nature of property development projects.
Exactly. And that lower revenue was the main driver behind the pre-tax loss reported for the property segment this quarter. The reports also list the usual suspects influencing property: general economic conditions, demographics, location value, building costs, interest rates, rental levels, property condition, quality of management, all the typical factors.
Makes sense. It's very sensitive to cycles and external factors. Okay, lastly, hospitality, hotels, and resorts.
Hospitality reported a higher pre-tax loss compared to the same period last year.
Higher loss. Why was that?
The reports pin it mainly on higher operating expenses being incurred during the quarter. Costs went up.
Higher running costs for the hotels. What kind of things influence this segment day to day?
Well, the obvious ones. Room rates, seasonality, think holidays, school breaks, overall tourism flows, currency exchange rates, which impact international guests, and then all the operating costs like energy, cleaning, food supplies, staffing. They've even mentioned specific things in the past, like monsoon season hitting East Coast resorts, or, believe it or not, a volcanic eruption in Iceland affecting their properties there.
Right, so very exposed to travel trends, costs, and even acts of nature. Okay, so pulling it together. Services driven by gaming look solid. Non-food retail has bright spots like luxury cars and cost control. But food retail, property, and hospitality are facing significant challenges, dragging down the overall group result.
That sums up the segmental picture presented in these latest financials pretty well.
Now, across these reports and the analysis, there's frequent mention of rationalization and restructuring. What do these terms actually mean in the context of B Corp? What are they doing?
Well, rationalization seems to cover things like that cost-cutting exercise we saw at Causeway, making existing operations more efficient. Restructuring, on the other hand, seems more fundamental. It looks like actively reshaping the whole group portfolio, deciding which businesses to keep, which to get rid of, and maybe where to make new bets.
Okay, which leads to the obvious question. Is this just talk, just strategy documents, or is there actual hard evidence of this restructuring happening now?
Oh, there's definitely concrete evidence. If you look at Note A8 in the Q3 2025 report, it lists specific changes to the group structure just within the 9 months ending March 31st, 2025.
Yeah.
These aren't plans. These are things that have actually happened: incorporations, acquisitions, disposals, liquidations.
Right. Let's run through some of those examples from Note A8. What moves did they make?
Okay, so additions first. In July 2024, they incorporated a new 51% owned subsidiary, Tenaga Berjaya SDN BHD. Its focus: solar photovoltaic systems.
Interesting, a move into renewables.
Also, in July 24, they bought a 51% stake in a software consultancy company, MyInvoice2U SDN BHD.
Adding software services. Okay, what about exits?
In August 24, they sold off a 50% owned subsidiary called Survegano SDN BHD.
Right, trimming the portfolio.
Also in August 24, they set up a new wholly owned subsidiary, Berjaya Hospitality Group, MSDN BHD, seemingly to handle management consultancy services, maybe centralizing that for their hotels.
Potentially streamlining hospitality management. Makes sense.
Then in September 24, Sports Toto Fitness SDN BHD was struck off and dissolved. So out of that fitness venture,
Amazing fitness. Keep going.
a potentially significant one.
Yeah.
Also in September 24, Causeway China Co. Ltd. completed its voluntary liquidation, so it ceased being a subsidiary.
Wow, exiting the Causeway direct selling business from China. That sounds major.
It does. Then in October 24, Mothers and Vogue SDN BHD, which was 82.8% owned, was struck off and dissolved.
Another one gone.
On the consolidation side, in December 24, they increased their stake in Adcast Life Science SDN BHD from 50% to 100%, making it fully owned. Looks like they did that via capitalization and acquisition.
Doubling down on bioscience then.
Also in December 24, UT Equities SDN BHD finished its voluntary liquidation.
Another liquidation.
And finally, in January 2025, they incorporated a new wholly owned subsidiary, Hatfield IO Limited, based in the UK, specifically for property investment there.
Okay, so quite a flurry of activity. Entering solar, software, UK property, getting out of fitness, Causeway China, Survegano, Mothers in Vogue, UT Equities, and taking full control of the bioscience venture. That's clear evidence of reshaping the group.
It really is. It shows they're actively buying, selling, consolidating, and winding down different parts of the business. It's not static.
And the analysis mentioned this activity impacts the balance sheet, specifically the equity figures.
Yes. The reports show the total equity attributable to the parent company's owners decreased. It went from about RM 6.48 billion at the start of their financial year, July 1st, 2024, down to roughly RM 5.90 billion by March 31st, 2025.
A drop of over $500 million ringgit.
Right. Now, part of that change is due to the comprehensive loss they reported and maybe share buybacks. But the analysis specifically notes that these changes in the group's composition, the buying and selling of subsidiaries we just talked about, are also a direct factor contributing to that shift in the total equity figure. It literally reflects the changing shape and value of the group.
Makes sense. The value of the parent stake changes as the underlying assets change. Okay, let's try and synthesize all this. Thinking about overall financial health, based on everything we've seen, what's the picture?
Well, beyond the headline profit loss, the cash flow situation really jumps out as a concern from the reports.
How so?
For the 9 months ending March 31st, 2025, the group didn't generate cash from its operations. It actually used cash. The net cash outflow from operating activities was RM 43.671 million.
Operations consumed cash instead of generating it? That's not ideal. How does that compare to last year?
It's a huge reversal.
Yeah.
In the same 9-month period last year, they generated over RM 727 million from operating activities.
Wow. From plus 727 million to minus 44 million?
Exactly.
Yeah.
The analysis document flags this negative operating cash flow as a major red flag. It suggests they're having trouble converting their business activities into actual cash, which is pretty fundamental, especially when you're already reporting losses.
Absolutely. You need that operational cash flow to fund investments, pay down debt, run the business. Speaking of debt, what's the borrowing situation look like?
As of March 31st, 2025, total borrowings were substantial, sitting at RM 6.45 billion roughly.
Over 6.4 billion in debt.
And the analysis really highlights something important here. Because operations were using cash, the group had to rely on net cash generated from financing activities, meaning primarily drawing down more loans, taking on more borrowings just to meet their overall cash needs during this period,
Mm-hmm.
covering the cash drain from operations and whatever they spent on investments.
So borrowing money to cover operational shortfalls and investing, that obviously increases financial risk, doesn't it? Like refinancing risk down the line.
Precisely. It makes the company more vulnerable, especially if interest rates rise or if lenders become more cautious. Relying on debt when your core business isn't generating cash is a tricky spot to be in.
Okay. Now, the analysis document we have included a financial moat scorecard. What score did BCorp get, and what were the main reasons given?
The score assigned was 4 out of 10.
4 out of 10. So on the lower side, suggesting potential vulnerabilities, what drove that score down?
The reasons cited really echo the points we've been discussing. The fact that the group is currently loss-making overall. The negative operating cash flow we just talked about, that's a big one. The high debt levels and the reliance on financing activities. And the specific structural issues identified in certain segments, like food retail, plus those rising operating costs hitting hospitality profitability. It all points to a currently weakened financial position.
Were any counterpoints or mitigating factors mentioned that prevented an even lower score?
Yes, the analysis did acknowledge some potential strengths. The underlying value and performance in specific areas, like the non-food retail, especially HRO and the services segment with its gaming business. It also explicitly mentioned the ongoing rationalization and restructuring efforts as a positive sign that management is actively trying to address the issues and build resilience.
So acknowledging the efforts to fix things.
Right. And finally, it also noted management's own outlook, which, while cautious, was optimistic about the domestic economy, providing some support going forward.
Okay, so summing up the health check. Current financial strain is evident: losses, negative cash flow, high debt leading to that 410 score. But there are valuable parts of the business performing well, and there's clear action being taken on restructuring alongside some cautious optimism from management.
That's a fair summary of the somewhat mixed but currently challenging picture.
So looking forward, what does management themselves say? What are the directors' expectations according to the Q3 report commentary?
They start with a macro view. They expect Malaysia's economy to keep growing, helped by strong domestic demand and inflation easing off a bit, although they acknowledge global geopolitical tensions as a risk.
So they're counting on the home market to stay relatively robust.
Seems so. And building on that, they specifically state they expect the performance of their domestic business segments to improve, thanks to recovering consumer spending and more tourism activity.
Which should help their retail, hospitality, maybe property segments here in Malaysia?
You'd think so. And they also single out the gaming business again, saying they expect it to continue delivering growth because the lotto and digit games remain popular.
Right, relying on that consistent performer.
So, putting those factors together and adding the usual caveat, barring unforeseen circumstances, the directors wrap up by saying they are cautiously optimistic that the group's performance for the final quarter of the financial year, the one ending June 30th, 2025, will be satisfactory.
Cautiously optimistic. It feels like the right phrase, given everything we've discussed. It captures the challenges, but also the potential upsides and the ongoing efforts.
It does feel like an appropriate description of their current stance.
Okay, one more area to cover before we wrap. The reports also gave updates on some significant legal proceedings. Now, these aren't directly operational results for the quarter, but they could certainly have a financial impact down the road, potentially positive or negative. What were the key cases mentioned?
There were three main ones highlighted. First is the STC proposals proceedings. This relates to a land development deal. The big news here is that the federal court actually ruled in favor of the BCorp entities involved back on October 30th, 2023.
A win at the top court. Good news for them. What's the current status?
The report says the main legal fight over liability is over. The only remaining step is for the High Court to decide how much compensation should be awarded to the BCorp entities. Interestingly, a judgment on that compensation amount was scheduled for just a few days ago, June 5th, 2025.
Right, so they've won the case, and the amount they might receive could be determined very soon. Definitely something to watch for a potential cash inflow. What was the second case?
That's the GMOC project arbitration proceedings. This concerns the sale of a project over in China. In this case, the Hong Kong International Arbitration Center issued a final award in favor of BCorp's subsidiary, GMOC. And it's for a pretty large sum, RMB 974 million, plus interest.
Nearly 1 billion renminbi awarded to them. Are they actually collecting that money?
Well, that's the next step. Enforcement proceedings are underway in both China and Hong Kong to try and recover the awarded amount. The report mentions some assets have been frozen for potential auction. They did manage a small partial recovery. Already, RM 17.5 million was received in the previous financial year. There's also some action involving the bankruptcy of a key individual involved.
Okay, so they have the award on paper, but actually turning that into cash is an ongoing process, apart from that small initial recovery. Still a potentially significant future asset, though. What's the third legal matter?
The Ahmad Muhiba tax dispute. This involves the subsidiary, AMSB, challenging a tax assessment for the 2017 tax year.
A dispute with the tax authorities. How's that progressing?
AMSB actually won its case at the Court of Appeal. The court ruled unanimously in their favor on December 19, 2024.
Another win for BCorp side.
Yes, but it's not over yet. The Attorney General Chambers, representing the government, filed a motion seeking leave to appeal that decision to the federal court on January 18, 2025.
So the tax authorities are trying to take it to the highest court. Is the tax payment itself on hold in the meantime?
Yes, the High Court granted a stay on the payment. So AMSB doesn't have to pay the disputed tax amount while they wait for the outcome of a related judicial review application, which is now linked to the federal court's decision on whether to even hear the Attorney General's appeal.
Got it. So potential upside from the STC compensation and the GMOC award recovery, but also a potential tax liability hanging in the balance with the AMSB case, depending on the final court decisions. These are definitely important contingencies.
Absolutely. They're not part of the Q3 operating results, but they represent potentially large financial swings that could affect the company's balance sheet and cash position significantly in the future. Worth keeping an eye on.
Okay, I think we've covered a lot of ground here. Let's try to boil it down to the key takeaways from this deep dive into B Corp's latest results.
I think the main story is a conglomerate navigating a tough period. The headline numbers show losses, but that's heavily skewed by the lack of huge one-off gains seen last year. Operationally, there are real pressures, particularly in food retail, property, and hospitality, leading to that worrying negative operating cash flow. High debt and reliance on financing add to the strain, hence the 410 moat score.
But it's definitely not all bad news. There are strong segments, like gaming and parts of non-food retail, providing some stability. And maybe most importantly, there's very clear evidence they aren't just sitting still. The restructuring is real, with businesses being bought, sold, and shut down. Plus, management holds on to that cautious optimism about the domestic market.
That's right. It's a complex picture. Clear financial challenges right now, but also valuable underlying assets and very active steps being taken to reshape the business for the future. They're trying to navigate through the current headwinds while repositioning strategically.
Which brings us to a final thought for you, the listener. We've seen the numbers, the segment performance, the restructuring moves listed in the reports. But given this mix of challenges and active change at B Corp, what factors beyond these reported financials might really signal a turning point? Could it be the successful execution of turnarounds in those struggling food or hospitality units? Maybe the smooth integration and growth of those new solar or software ventures? Or perhaps unforeseen shifts in consumer behavior that either help or hinder the recovery? What non-financial signals would you personally look for to gauge if this restructuring is truly gaining traction?
Something to think about. Thanks for joining us on this deep dive.